to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, looking fresh, looking dapper. Good morning, AJ Brown.
How you doing, Sip? Hey, everybody.
I'm doing well. Episode 99. Can you believe it?
99. No, I can't believe it. This little experiment of ours that I thought would last maybe 20 episodes, we're coming up on 100.
Hey, it's educating the public. It's revealing your strategy, your insights into the market, and it's helping people to consistently grow their investment. Right? That's the idea behind the show. That's the idea behind Trading Trainer, and that's why we're here today. We've got a special guest on later today that we're going to be getting a little bit of insight, additional commentary on the markets. But with that all being said, let's just get into the big news of the week, right? So last week we talked about, well, what's the Fed going to do? This week they did what we thought they were going to do, but it's still very confusing. I see a lot of headlines. I'm very confused. AJ, can you break it down for us?
I mean, the Fed did exactly like we expected them to do, which was they did nothing. But we talked about this last week, and the key is they had their quarterly press conference afterwards, and their rhetoric is almost, if not equally, as powerful as, their policy changes, right? They've continued to do their bond selling, which is behind the scenes kind of the reversal or the undoing of their quantitative easing. But a lot of people focus on that interest rate hike. They didn't do anything with interest rates, but they were very, very hawkish. They put a tone out there like they could do more interest rate hikes before the end of the year. You look back over here, we've got our CME FedWatch tool on, and investors really don't believe that that's going to happen right now. If we take a look right now at the November expectation, it's about 3/4 of the investors expect that it's not going to change. There is a growing percentage that say there might be a 1/4 point rate hike. You fast forward to the December 13th meeting, and it's a little bit more spread out, but still there's a lot of investors who don't think much is going to happen before the end of the year. But yet, the Fed, they talked about that smooth landing and how they were wishful for it, but not fully expecting it. They reduced their everybody was thinking that not only would the Fed kind of slow down on interest rate hikes, but maybe next year they might start undoing them, and they kind of squash any expectation around undoing it, that interest rates might remain high, or what they consider high for the short term here into next year and midterm. So that kind of caused investors to react. Now, last week we also talked about how during this month of September, after people came back from that summer doldrums, that there was a lot of confusion, a lot of frustration, a lot of anxiety, and a lot of, or not very much, guidance coming in from external sources. And so if you can think about that, putting a whole bunch of people into a small area and not letting them do anything, they kind of get anxious whenever there's any little tidbit to grab onto. And so I almost feel like this, and it's showing all the characteristics of it, this move that caused this price action on Wednesday and then the follow through on Thursday. If we take a look back at our charts, and I'll just clear off some of this drawing stuff that I have here. Let's go ahead and click here and come over here and go to our default drawing. So we had this big sell-off on Wednesday after people started to digest what the Fed said in the afternoon. Thursday, there was gap down. It continued. Now we're kind of getting some sense. I call this a transient external stochastic shock. So transient, it means that it comes and it goes. As soon as it's in the rear view mirror, people kind of recover it. External, it's not from any internal generated market forces. It's like an announcement, like we had with this Fed announcement. Stochastic, a big move. Stochastic is typically measured on a logarithmic scale, and then shock. It was a surprise, right? And so, what that is a big name for is something that we let pass and allow the market to recover and start to take trajectory from there. So I'm not giving it much credibility. I think it was an overreaction of sorts, but we've got to take it for what it is. A lot of folks who are in, positions, especially long positions, may have gotten stopped out. This is a great time to look for a good time to get back, especially if those positions were your covering positions for premium selling trades.
So my question is, some of the headlines that I saw continue to come out after the Fed was bonds, right? And so
Hmm.
because they said that they wouldn't be cutting in the future, like next year or the year after, was there a more of a dramatic effect on the bonds that could
Hmm.
trickle in, like that isn't really shown in the equities? But I kept hearing it and I couldn't put the correlations together.
Well, there's been this balance for as long as when you go and you visit your investment advisor, they're always talking about the balance in your portfolio between bonds and equities. And as of the last decade or so, bonds have not been very valuable. So portfolios got very heavily weighed in the equities, and even the more riskier dollars were going to newer types of assets like crypto and things like that. But now, with this huge increase in the last 2.5 years of interest rates, bonds all of a sudden are a viable investment again. And so when they're saying that they're going to keep interest rates high, those bonds are staying at high returns as well. Money's flowing from the equities market into the bonds market, and then add to that we've got the price of oil knocking on $100 US a barrel. And, you've got kind of a recipe for equities to have a little bit of a sell off and people to question whether equities are going to go higher or not.
All right. And then the only other follow up that I have is something that we can transition to into later in the show. But seeing the drop off this week, I would assume that the volatility increased, and the VIX is a tool that we like to look at to measure that. And I think the answer to that is it did a little bit, but it's still historically very, very low. We've been saying that for weeks now.
Yeah, of course. The VIX popped, but you can see here I've got this white dotted line up here at the top. This is the overall mean. And so we know if we take a look at the bigger picture, and I'll go ahead and I'm going to show you the whole VIX since the beginning of time. You can actually, not the beginning of the time, but the beginning of the VIX, you can actually see here that so as the VIX goes up, that kind of is a measure of fear and anxiety and confusion in the markets. And if the VIX is low, it's a measure basically of confidence, right? Confidence in the market. And it's really interesting. It's a huge psychology experiment for sure, because when you look at this overall, you can see, for instance, what happened with the market in 1987. You can see the dot-com boom and bust. You can see the 2008 recession. You can see the COVID pandemic, and you can see that humans tend to freak out, for lack of a better way. And so that's when these huge peaks in the VIX happen. But when it comes to being calm, cool, and collected, they only get to a certain part below this mean. You never get super confident as humans, but boy, can you freak out when things seem to go wrong. So I really love the correlation. A lot of people come to me and they're talking about a lot of math and a lot about indicators and all these things in order to read the market. And truth, it's really just kind of understanding the psychology of the tribe mind. And that's kind of what you're seeing here. When you look at things like this, when you look at, for instance, how options expire with time, That's just a huge psychology experiment on human procrastination in my interpolation, because you can map these things with like a psychology 101 studies, and it's almost a one-to-one correlation. So, it's more about understanding the human psyche than it is really understanding all sorts of math and indicators as people might perceive investing is about.
Yeah, and we bring that up a lot just because not just because, but the options and the strategies that you implement are very much tied to the concept of volatility and time. And so I like to compare it to what's going on into the news, because it's like, is the market freaking out? Are people freaking out? Or they're not freaking out? And it seems like they are not freaking out historically. So we're constantly looking for opportunities to take advantage of that. That's what you and the team at Trading Trainer are doing every week. And with that being said, let's go ahead and give everyone an opportunity to jump in and check out AJ's daily workshop. So if you're watching for the first time, listening for the first time, and this is something that you're interested in learning more about what AJ and the team does, he's got an awesome daily workshop where he reveals 4 of these strategies. It's completely free. You can jump in there at your own time. I just threw the link in the chat. And so if that's something that you're interested in checking out, head on over there and sign up. We are broadcasting live. So if there are any tickers that you want AJ or our special guest to maybe go over, feel free to throw it in the chat. And if we have some time, we'll get to it. Otherwise, we're going to take a bit of a break. We'll come back, talk about our trending topic, bring on our special guest, talk about a little freebie that we're going to be giving away, and getting into our pick of the week and our speed round. So stay tuned. We'll be back in a few seconds.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. The link to that webinar is in the chat. Head on over there and sign up.
Hey, Sip, before we introduce our little guest, can I just say one last thing? If you take a look at my screen, I've got my retracement analysis up, and it looks like a crap show, for lack of a better word. But basically what we're diagnosing here is that we're in a sideways choppy market. So if you're a long-term investor or you're more of a trend trader, I think you're going to have some difficulties in the short, even midterm. But if you're focused on different ways to make markets, like make profits, like for instance, some of the strategies we like to use, just simple legging into some premium selling trades. I mean, this is your cup of tea. This is where we want to be. So I just wanted to throw that up as well.
Yeah, and we'll definitely be looking at more of those as we pull up some examples and look at opportunities. All right. I feel like we should get someone on who knows a little bit more about the markets and has some better insight than myself. And so without further ado, let's go ahead and bring our special guest. This is Serge Berger with The Steady Trader. If you haven't checked it out, it's thesteadytrader.com. It's got a podcast and got some great indicators. Serge, thank you for coming on today. Thank you for taking some time. We're excited to hear your thoughts on the market. Maybe we could start there.
Well, first of all, I'm honored to be here at your 99th episode.
That's right.
Wow. What do you talk about for 99 episodes?
I mean,
Awesome.
we never thought that we would have this much content, and the truth be told is every week we've got something new to talk about. The market deals us a hand every week, so it's worked.
Yeah, for sure. Great content. Again, great pleasure to be here.
Any thoughts on the market right now, Serge?
Sure. I was listening to your bit before about the post-Fed. I mean, as far as I'm concerned, we're in a, markets don't exactly repeat themselves. It's, kind of, Mark Twain, it tends to be more of a rhyme. But I have to say, this period right now reminds me very much of to some extent, of what happened just before the dot com. Oh, excuse me, before the dot com, and also what happened, um, essentially right after or before the great financial crisis. Those were really the periods that I think were most similar to what's happening right now, and it's because a lot of people were in denial. Is really kind of what it came down to. A lot of people were in denial, in denial of the economy slowing,
Mhm.
and if you look at the data, whether it's credit card debt, consumer spending, um, I mean, those are just the peak of the iceberg. Um, I think COVID has really distorted a lot of things, and but ultimately, economies slow down when rates go from 0 to 5 in 18 months.
Yeah.
And so, in terms of what you like, your approach, what you're doing in your program, how are you positioning yourself? Because earlier in the show, we talked about implied volatility and the VIX, and a lot of AJ strategies are correlated to that logic. And so, what is your approach? Are you what are you and your crew getting into? What are the kind of the approaches that you're looking for? And is this a good market for your strategy?
I'm assuming you're talking about more on the trading front as opposed to the investment side, right?
Either or. I mean,
Okay.
I would assume that most of our viewers now aren't really familiar with what you're doing over at the Steady
The
Trader.
steady
So
Okay.
trader.
yeah.
Yeah, no problem. Well, I mean, I first of all, I'll just as a disclaimer, I have another company which is an investment advisory firm, an RIA. It's registered to the teeth, and that's an investment advisory firm. So that's more investment and advisory focused as opposed to really quick trading focused. So just quickly on that, I really believe everyone should first and foremost have a diversified portfolio and then trade with maybe some of your money. Let me just, as a disclaimer, say that that's core one of my core beliefs. Um, on the trading front, which of course we do, I'm going to consider trading to be more of a, you know, very near term, might be a couple of days. Um, Still very near term, maybe a few weeks, and then maybe a few months. But in essence, I think we have to be prepared for potentially one more rally on the equity side. And I don't know what you think about this, AJ, but the channel checks and the hedge funds and all the guys I speak with that I used to either work with or still work with, um, there is the threat of one more rally in equities if we start to get one really good inflation report, meaning, or something that basically speaks to the economy slowing. Because I think there's still too many options positions and, structured products. And we can talk about that if you guys want to, what that means from an options flow perspective. But there's a lot of natural option sellers out there that are suppressing volatility. And I'm an option seller as well, um, to some extent, but I'll only do that to the extent that it makes sense against the grain. So, in other words, what if we get, let's say, some sort of report that says the economy is going, you know, uh, down the tubes, let's say, um, and what would then happen to bonds? Well, bonds will probably rally, yields go lower, and the question is, and I think this is really what everyone's thinking about that I'm talking to, is would that lead us to one more equity rally and bring the last hope back in, and then we're done? And I don't have an answer to that, but from a positioning perspective, I'm very defensively positioned. Um, I will be more than happy to buy a dip very, very tactically if we see something like what I just laid out um, come to fruition. But I think what people are not thinking about as much right now is, again, the risk of economic data coming in quite badly or some sort of external shock. Again, listen, the rates have come from 0 to 10. You look at the brokers, how they're trading. You look at the banks, how they're trading, regional banks, the whole complex. Rates are falling off a cliff over the past few days. I was an investment banker at JP Morgan, the fixed income side. And, so that's kind of my sweet spot. But I really think there's a lot of stuff rotting under the surface.
And so
Do you
AJ
want to
would
take a Do you want to take a look at the VIX surge? We were going to take a look at that as part of this trending topic. You want to share your screen, or do you want me to share my screen?
Well, it doesn't matter. We can look at whatever you prefer. Doesn't matter.
I've got you up, AJ. You're up now.
Okay.
Yep.
Well, so we were talking about this when we had a little call in advance about the VIX being at recent lows. What are your thoughts?
So, in general, when we're in this economic environment where growth is decelerating and inflation remains sticky, we're essentially in a stagflation environment, as far as I'm concerned. And so we're mostly positioned around that. In those kind of environments, you basically want to be buyers of volatility when you get to the low end of the range. Now, the low end of the range, which is literally the all-time low of the range, is somewhere below 13. I think my all-time low I ever saw in my career was about a decade ago. I think something like that. And if we can go back, I think I saw a 9 VIX at some point. It was nuts. It was a 9 VIX. It was in 2018, something like that. I mean, you don't get that much, and then of course the VIX went from 9 to 42. But in general, that's an extreme. If you get below 13, you're at an extreme level of complacency in this economic environment.
Complacency is a good word.
So that's kind of where I think we are. But again, if you want to be very tactical about it, I would not be surprised if we get some sort of a shockingly bad economic data point and the bulls still want to believe this and Wall Street still wants to push some more narratives about soft landings or no landings or unicorns and puppy dogs and whatever, then I would not be surprised if we see a VIX go back down to the lower end of that range. Equities have one more push, and then typically it's really over. You need Wall Street to change their tune. And basically what happened, I don't know if you noticed it, I've never seen it as pronounced in my career as I saw in May, June, basically all around the NVIDIA numbers, because it was the only game in town. Everything else wasn't doing well. So basically every Wall Street analyst in terms of the macro guys took off their recession call and kind of said, for now, no recession, which was the right call, by the way. It just depends what data you look at, of course. But that consensus can change, and it will change, but it'll change in a lag effect, so it'll change once things have already moved. The VIX will be at who knows where once they do that, and then they'll start peddling the bearish positions. So long story short, I think lower end of the range is what we've seen, 12.5, 13. That's the very low end of the range. The upper end is really unlimited in many, many ways, but maybe for now it's 25.
Let me ask you this, Serge. You and I were talking about some of the IPOs. Like, we haven't seen IPOs in a while since all of these rate hikes. And you had a great observation that so the one we were talking about is ARM, but even this week we had Instacart. What's your thoughts about these IPOs? It's not the IPO season, if you will.
It's not. It's a great point, right? So basically, when you look at IPOs, right now there's a backlog. So if I talk to my friends that still work at the syndicate desks over at JP Morgan, there's still a backlog of companies of private equity owned stuff from the pandemic when money was free and growing on the trees and growing as weed on the sidewalk. And those companies basically are kind of, they're still in shackles and they want to get out of those deals. They want to go public. And there has to be, it's just not a good time to be that in that position. So they'll come to market when there's a bit of a window, and you always have to ask yourself, why does a company want to go public? It's mostly because private equity's made their money. But right now we're not in an environment where people are chasing charts as much anymore, although still too many arguably are. But there's a lot less. So these IPOs are not going to, if you look at the performance of IPOs, it's been dismal. I mean, these things have not moved compared to the admittedly insanity we saw during the pandemic where everything was just going up.
Right.
All right.
Yeah,
Well,
there's always a reason a company wants to go IPO if it's especially if it's at a time like this. And one of the things that we were saying is it's like you said, private equity's already made their money. They're packaging the company up for some sort of move or acquisition, merger, or something like that when they do something like this. So maybe that
And you have to think
our-
about rates, right? This brings it back to rates. So it's, money is no longer free. So it actually takes a really good story, not I may make a profit at some point in 20
right.
years or 2 careers from now. And so I think that's something worth keeping in mind. Now, if you look at, just as a fun fact here, I was looking at factor exposure. And for those people who don't know what factor exposure is basically how hedge funds look at the world, and certainly fund of funds. What's a factor? It's let's say momentum strategies, small cap strategies, IPOs, growth, versus let's say a benchmark like a basket of equities that's more broad-based, like New York Stock Exchange. The S&P is not a broad-based index anymore.
Yeah.
Fun fact, AJ, the IPO is actually the second best performer through sort of, if you compare against, like, say, growth and other things this year versus in terms of factor exposure. The IPO stuff is still up 10% versus the S&P. So 10% relative outperformance, which is exactly like growth. So growth, stocks, and IPOs, and of course IPOs are much more volatile, right? So the risk-adjusted return is not fair because IPOs are much riskier in that sense. So anyway, it's just recently the ones that have come to market have not done well.
Yeah, it's a good observation.
all right,
that's
gentlemen.
good.
Well, we'll have more to discuss. Serge, you obviously have a very unique perspective, and it sounds like you have some connections and getting the right information from where money flow is coming from, and so we've got a special surprise next week. You and AJ, or mostly you with AJ, are going to be kind of giving your breakdown of your tools, your strategies. You're going to be hosting a webinar showcasing the #1 pattern to beat Wall Street's cheat code. You're going to throw 3 steps to simplifying swing trading in these volatile markets, how to cut through the noise, and just approaching the current markets. And so maybe you can give us a little bit of a glimpse into what that is with this week's pick of the week. Now, we've gone ahead and let you throw out a name that we can go through. Usually AJ gives us his pick of the week. This week we're going to throw the baton your way. And AJ, I think you could pull it up on your screen, or if we could get Serge, I don't know if you have some
yeah, I can show you some wizardry if you want. I'll share my screen. Is that okay with you guys?
Without a doubt.
Awesome.
Just so that everyone knows what your pick of the week is, it's going to be Ulta, ticker symbol ULTA. Is that correct?
That is correct. So just for a little bit of perspective, before we look at the squiggly lines, and I had to chuckle before when I was looking at your charts, AJ, in terms of the, I remember one of my, and this, I'm going off a tangent, so excuse me just for 1 second, but one of my support staff a few years ago, he showed me a screen share of some support call he had with a client. And the client had literally, like, I don't know, probably about half a dozen or maybe a dozen indicators on his chart. And somewhere at the very top, what looked more like an actual, like, I don't know, like a menu, you saw one little squiggly line. That was the price. So, and of course, you and I know it really needs to be the other way around.
Yeah. Yes. It has to be limited and focused.
Exactly. So
I love your software package, by the way. The one that you're demonstrating right here. I actually got it.
I will show.
Sorry, go ahead. No, I was going to say I got
that.
a sneak peek at that software package when you and I were together in Las Vegas a couple of months ago. So I love that you're demonstrating it right now.
Okay, perfect. Yeah, I think this is actually different, but I mean that's a great tool as well. So maybe just quickly a setup. So for those people that can kind of get their head around that the consumer spending as slowing, which is factual at this point, there's really very little argument there. Question is how much. you look at something like Ulta Beauty. Like, I don't know if you've ever been to one of those stores, but there's one right next to the wine store. So I know it exists. And so I've gone into that thing, and I made the big mistake of telling my wife that it exists. And then, anyway, so I went in there, and this was during the pandemic, and I need to understand what it is. And so I've been kind of watching this. It's a pretty good stock to measure consumer sentiment and behavior and, pockets. So Ulta Beauty, it's cosmetics. For those people who don't know, should be in the name. Big pandemic name to some extent. It was kind of choppy, and then as everyone started having to go back to work and put on makeup for the first time in 2 years, so they didn't look like zombies anymore. They all rushed to the cosmetic store. Now, of course, that story has run its course, and Ulta is essentially now off about 30% from the highs in May. And it's basically staring over a cliff. Now, this is now we're getting more into the technicals, right? The near-term stuff. So as far as I'm concerned, AJ, I mean, I think just to the trained eye, this does not look like something that's about to rip roar higher unless there's some amazing good news. I would imagine you, all else being equal, probably agree.
Yes.
So if we can get our head around this, the next stop to me is probably closer to somewhere around, 370 and which is historically speaking, there's a lot of price action down there. So, that's
exactly
kind of it.
Right.
That's kind of in a nutshell how I look at it. And you can look at it another way too. If you look at the consumer spending, I mean, we could pull up Starbucks, and I'll show you the indicator that gives us these signals in a minute, but you can look at Starbucks too. And, again, same. So let's take a step back. I don't know about you, AJ, but if I were to lose my job, I'm probably not going to drink more $7 lattes. I'm probably going to drink a few less.
Yeah, I'll go to McDonald's and get the mud. The stuff
yeah,
like mud,
filtered mud, exactly. So you switch to that. And fun fact, and not to move away too different from the other stock, but Starbucks does have for those people that like to draw charts, lines, and annotate things. This more or less is a head and shoulders pattern we saw before. Now, again, I'm a really, really big believer, having worked on Wall Street for just a little bit too long. You can't just use a chart. You have got to put perspective around it and have a story. So that's why I'm telling you a story about Ulta and Starbucks. Now, what's giving us the signal? Well, one of the things that I like to use, and we'll talk about this next week, AJ, is I like to know when there is computer algorithms coming into the market. Now, I'm here to tell you it's a difficult thing to do, and it will never be able to tell when all or even more than maybe 30% or 20% of algorithms come in, or even less than that. But if we can tell some, we've got a really good chance of going with the flow. And so one of the signals we got after doing all this analysis, that we saw some pretty big sell programs come back into this in mid-August. This is the algorithm that we're going to talk about next week, if that's okay with you, AJ, and how we can kind of, instead of fighting the algos, right? So like, who are you and I to fight, skyscrapers full of smart algorithm towers in New York? Why not go with the flow and kind of, see if we can go on their backs. And so we saw sell signals come into the market very clearly there on the 17th of August, and that continues to work out. There has not been any let up. Those are pretty persistent sellers in the market. And so Ulta, I think it's a short.
Mm-hmm.
And so just a quick follow up to that, because AJ, we get a number of tickers and symbols that hit the help desk all week. And so usually at this point, AJ would break down the options approach to this down pattern. And so AJ, if looking at this chart, what would you like? How would you be guiding our and the Trading Trainer members to get into a position to the downside here?
Well, I love the idea of either doing a short position on the stock itself or buying some back month, deep in the money, far out in time put options. And now you're set up for that down move. And what's really neat is I agree with Serge. I see that level of support around 370, 380. You can calculate that into your trade plan. And if you wanted to turn that into a position where we could sell some front month near term at the money put options every expiration and create some income off of that, that's great. Now, if it dips down lower than that, and I would, put a cap on that, but I would put a threshold, I don't know, 360, 355, then don't worry about selling premium. Now we're going to just look for an exit on that initial position because you basically got that down move, and that's going to far surpass any combination of income. So I love this position on Ulta. So, if you can afford it, if you have the risk appetite to take it into your portfolio, that would be a good thing to do. It's pricey.
Yeah, it's pricey, and you also have to think about the premium in terms of volatility. I mean, it's
Yep.
not it's not a 90 vol, it's a 25 vol, which given this name, one thing that you always have to keep in mind with a stock like this, which is why I'm not shorting the stock. I'm basically long some way out of the money puts around the levels you mentioned there, several months out.
Yep.
You always have to be concerned. I used to know the CEO of Revlon. Very, very nice guy. And, he used to always tell me about the beauty industry being, very much one of consolidation. So you would have to be at least a little bit aware and
Mhm.
concerned of some sort of a M&A activity. Now, rates were no longer 20 basis points. They're 5,
They're
right?
5,
Five and a
right?
half on your 3-month, 6-month T-bill kind of thing, or 1 year. M&A activity at this point. I mean, we saw a deal get done yesterday. I think Cisco bought some for $8 billion. I think it was
But for the
stock.
most part, it's squashed for now.
Yeah, the markets are basically frozen right now. The IPO, sorry, the IPO market
M&A.
too, but M&A really for the most part it's kind of a tundra. So you just have to be mindful of that. Earnings, just for fun. Ulta does have earnings. I think it's in November. Just quickly check again here. I thought it was November. So that's another thing you want to keep in mind, at least
End
for
of
me. Yeah,
November,
November
I
30th.
think.
Yeah, November 30th. So no real risk there. Just again, the M&A and even though it's frozen, I agree. Obviously, you just want to be something. You always want to keep the risk in mind. So.
All right.
So you guys really need to check out our Wednesday webinar. Usually this is something that I would just advertise to the folks that are part of my paid programs. But I wanted to make sure you guys who are listening to either this show live or checking it on the replay also have a chance. There's no cost. You just register for the webinar. Check out, I'll be hosting it, but Serge will be the main presenter. You just check out what Serge has to say when he does a deep dive, and he has the whole time. He's not just a featured guest on the AJ Brown Show, but he actually has his own hour. And this is going to be like cutting edge stuff that I think you guys want to get into. So make sure you register for that webinar and set aside time next Wednesday. It'll be Wednesday, I believe, noon Eastern time. So noon New York City time. I'll let you extrapolate depending on what time zone you're in. And SIP has graciously put that link into the chat. So please click on it and just register your spot. Plus, we'll be making a replay available. It's best to always be there live because maybe we'll be able to take some Q&A during the time. So if you have some questions, get them answered right then. But register whether or not you can be there live or not, because you'll at least get access to our replay as well.
So, Serge, thank you for taking some time to jump on the show today to give us some little insight
Thank
into
you.
your approach. Like AJ said, the link to that webinar is in the chat. It's in the replay. You'll probably get an email about it. So head on over there and sign up. With that, AJ, with that, Serge, I guess we'll be seeing you next week.
See you guys next week. Thank you so much. This is a great show.
Thank you so much, Serge. That was awesome.
See you
Take
guys
care,
next week.
Serge.
Thanks so much.
All right,
God.
AJ, pick
I
of the
love
week.
I love it when people like that have that kind of expertise that come into our show. That is awesome. He is somebody, I met him. I've actually met him a few times, but I really talked with him a couple months ago in Las Vegas, and we're on the same page. We see the same things. He's got a slight different take on things. And so I love that relationship, and I'm glad he could make time for us today.
Yeah, and we still got more to come next week. So head on
Yeah.
over there, sign up for that webinar. All right, we've got a few minutes left in the show. Let's run through our speed round. Let's see if there's some opportunities from the fans and the viewers out there. AJ, I think we'll need to get your screen back on the feed because it
Sure.
looks like we've lost it. But let's run through some of these names and see if we can find some opportunities. The first name in our speed round. This is from John in Portland, Maine. He's interested in Baxter, ticker symbol
Ah.
BAX. This one might be a new one for us.
Baxter is a company that is based in medical devices. Anything for kind of the backbone of doing medical analysis and things like that. So let's take a look at the chart. First things we notice is the stock is at a modest price, about $38 a share right now. We also are noticing that let me get this menu off the screen here. We're also noticing that they have positive earnings. That's an important thing if we're going to make this an underlying symbol in our kind of trade strategies. And it's nice that they're giving dividends to their investors. That means that the investors are not going to be pounding down the door per se at Baxter, demanding that the company do something to raise the equity prices. If they're getting a fairly healthy dividend, a lot of the investors will be happy with that. So that creates kind of that ability for a sideways choppy stock that we can then turn into one of our premium trades where we can start pulling off an income on it. And we're going to want to leg into this, I think. I'm trying to go back here to find out when we had a little bit of a trend change. So I've gone back 2 years so far. I kind of want to just get, and this is something that I commonly do. This is like doing my homework and learning about the history of a symbol. So you can see that, especially during the whole trying to figure out the COVID pandemic, Baxter was trading in a sideways choppy pattern up here around the $80 point. Which kind of makes sense if you think about the whole story. Let's keep going back to even pre-pandemic. So I'll come and pull down the stock, and I'm going to go back, let's say 5 years. And I even want to go back, let's see if we can get back 10 years. And this way I'm looking at a monthly chart. So you'll notice Baxter spent a lot of time down at the range that it's currently at. And then it had that gain, and then it was up here. And then it only has probably, they didn't need as much of their materials. But what I notice as I look at the chart over time is that this symbol and the investors that price the symbol, because remember, there's correlation, there's the actual investors and their accumulation and distribution of shares of this stock. And then, of course, there's the performance of the company. They tend to like to have this thing go sideways. It has step function increases and decreases. So this is John. John, I think you found a great symbol. It looks like it's on a 2-month kind of down. So I don't want to do anything with this right now. Actually, there's one more check that we want to do before we come up with a plan around this. And that is, are the options, is there liquidity in the options? Sometimes there's not anybody trading these things. And one of the options that I like to check the most is not necessarily that near-term option, but I'd like to check about a 3 to 6 month out option, because I'll be using that option in my strategies as kind of a protective hedge. So that would probably put us in the January, February timeframe. So if I take a look at the February option, and I'm going for the February option because the January option, that's a leap. And so it's going to have more liquidity just because of the nature of being a leap. So if I want to get more of an understanding of what the regular option series are, I'll look at this February option, which was just created not too long ago and made available for us to trade using standardized contracts. Um, and I'm specifically looking at the bid-ask spread to make sure that there's investors in there. And the bid-ask spread on both the put and the call side look pretty small. And so that tells me that the market makers are in there and they're funding, they're okay making smaller spread because they know that they can do volume. So that verifies my check that there's enough liquidity for us to do some different, fun option strategies on it. But I want to let this symbol bottom, and I want to find out where it bottoms. And I may want to let this thing, once it bottoms, mature a little bit. That means I almost want to paper trade it a while. But when it bottoms, I mean, the other thing you might think about is Baxter in your portfolio for the long term, because who knows, another, cutting edge something in the medical world could happen, and Baxter through correlation may go up again. Some people would want to have this for the dividend. So in that case, once it bottoms, and I'm going to keep saying that, I don't want to do anything until I see it form a nice bottom and test that bottom. I could do some strategies like doing cash secured puts in order to buy that. It's basically like a limit buy order, but you get paid for it. So I could see doing that, picking a price and automatically reducing my break even or cost basis on it because I get a premium up front. And if I don't get anybody to sell me at my price, then I get to keep the premium. So I can see doing that strategy. I could see picking up some of the stock just outright and then looking for slight appreciations to then leg into some premium trades. If you do that, every time you sell premium, look down at your break-even price, look down at levels of support and place a protective option there that you can then roll out. Again, our protective options, 3 to 6 months out, strike price down near where we would bail out of the trade. I think those are great hedges, and we apply them at the same time we sell premium. Because remember, when you sell premium, you put yourself under an obligation to perform. So let's go ahead and make sure we insure that position at the time. Once that premium expires, we can then roll out of that insurance position. And a lot of times the appreciation on that insurance, because of the directional move of the stock, allows us to get out of it at a positive. So I like this, but I don't want to do anything now, John, until we bottom out.
All right, that's Baxter, ticker symbol BAX. We're keeping an eye on it. All right, moving on to our next name. This is Perry from Surrey, British Columbia, in a name that I never hear outside of this show, and this is Cleveland Cliffs, ticker symbol CLF.
Iron ore, right? They're like a way into the iron ore type stuff. So yeah, we wouldn't, since we're not in that industry, that wouldn't be something that we would see on an everyday basis. But it's the basis of like everything having to do with metal, right? Yeah, Cleveland Cliffs, one of my favorites, and I guess we're just checking in on it. This last earnings season, they made a nice chunk. I'm going to actually go take a look at a 1-year chart here. I can see my telltale support and resistance lines here. It looks like we've had, after this little pop in the beginning of 2023, we've settled down at a different cost basis or a different sideways choppy. And it looks like we've tested those levels. So guess what I'm going to do? I'm going to go ahead and delete that drawing, and instead I'm going to define a new level. Again, what I like about these type of companies is they're boring. They're not in the mainstream media, but they are necessary, and they've been in business for a while. They're going to continue being in business. So they're making money most of the time. It looks like we'll do a little research, but it looks like Cleveland Cliffs is seasonal, as you can see by the different quarters. But for the most part, we're at a bottom. And so I like the idea behind Perry identifying that bottom. This would be, again, a good opportunity instead of our buying the stock here. If we've got some back month, deep in the money, far out in time call options, I might consider doing that. I'd wait until I started heading back up a little bit. So maybe around the 1470 zone, I'd look for a purchase opportunity of those back month deep in the money calls. And then if it went and kind of topped anywhere around the $17, even as high as 1850. If it topped up there, that would be my key, Perry, in order to sell the call options and buy a protective put. And I would sell the near term at the money call option. So wherever I topped, that would be the strike price I used. For the protective option, I would examine my break-even price. I would examine these levels of support, maybe around $13. I could see selling the 13, buying the 13 or the $14. But again, I don't want to buy that until I've topped. So I'm going to buy it at a bargain basement price. And then as I go down, my sold premium will either hit its expiration date or it'll hit its low value on a dip in the stock. And my protective option, once I don't need it anymore, I can roll it out at a profit and then rinse and repeat, rinse and repeat. So I can see doing that with Cleveland Cliffs. I like where you're going with this. I'd go forward with that.
Yeah, at a very nice price point too, at like $14. So very reasonable.
Totally affordable.
Very-
Totally affordable.
All right, thank you, Perry. Cleveland Cliffs, ticker symbol CLF. That's our last ticker, but we did have one question that came up this week that might be worth reviewing, and it's a term or a topic that you reference fairly often, and that's
All the time.
hey, if you don't know what to do, or if you're kind of having a bad streak, do some forward testing. So AJ, when someone asks you what is forward testing, how do you answer that question?
Well, and this question came in from Manny. And so Manny's back engaged. Manny is our 6th grader who's been watching our show since the beginning. So here's the scoop, Manny. And I don't know if forward testing is an official term. I know back testing, of course, is an official term, but I use forward testing. It's basically paper trading or simulator trading. And here's the scoop. So when you identify a symbol that you'd like to trade in one way or another, whether you're going to use some option strategies to take advantage of whatever, the first thing you're going to do after you've picked the symbol and you've recognized all the patterns, not just the patterns in price, but the patterns in news, the patterns in implied volatility, all the different patterns, and you match that option strategy to what you're seeing, right? So pattern recognition and symbol selection is the first part. Once you've got that, you're going to create a trade plan, and in that trade plan, you're going to build in your risk management. You're going to take into account what's your risk appetite, what's the max risk of the worst case scenario of the trade, and size it appropriately, and so on and so forth. You'll come up with a written down trade plan. And a lot of these trade plans the steps of the trade plans are going to be triggered by some sort of indication in whatever the pattern is. It could be indications on the price chart. It could be indications on an implied volatility chart. It could be something happening in the news. Whatever your indications, you want to go back. And this is where I use back testing, because back testing, we have the privilege of seeing hindsight, or of using hindsight. So we know when tops and bottoms found, and we can go back and identify what triggered those tops and bottoms, or what could be used as a signal to those tops and bottoms in history, right? And then we can take the combination of the symbol we've chosen, the trade plan we've created, and whatever we're going to use to signal the triggers in that trade plan. Take those three things and you're going to forward test it. You're going to see if in real time, where we don't have the benefit of hindsight, this works. So you paper trade it, you simulator trade it, especially with the strategies we talk about here in Trading Trainer, where you're going to be in this symbol for months, selling, doing adjustments along the way, creating, premiums off of it. Now, the scoop is that I always recommend forward testing a lot of symbols at the same time. So not just one symbol, but create a trade plan and back test signals for other symbols. Have at least 5 to 10 of these going at the same time. And the reason is because as you're forward testing them and you include them in your nightly process as if you're actually trading them for real, you'll see through real time which of these ones is working out for you, which of these ones is giving you agita in the stomach, which of these is actually going to be a good trade to trade in real money. In actually following it in real time and doing the paper trading on it, those candidates of those 5 to 10 that are really worth putting real money into will float to the surface and you'll quickly identify them. And there's no other way to identify them, I've found, than to actually be following them in paper trades and see how the paper trades worked out and comparing and contrasting them to each other. So that's how, when I'm talking to the folks that are part of my program, I tell them how to forward test, Manny.
All right, forward testing. I'm sure that's not going to be the first time or the last time, actually the last time that we talk about it, because we do get some names out there that sometimes it's better not to do anything and just keep an eye on it. And that is what forward testing is. All right, once again, episode 99, AJ, we're getting close to the end here. Special thanks to Serge at the Steady Trader. If you haven't signed up for the webinar, that's next week. The link is in the chat. Head on over there. There's going to be a ton of information. Definitely a good perspective to learn some new approaches to investing in the markets. Serge seems like a very, very knowledgeable guy. So big thanks to him for coming on and giving us a little bit of insight. Yeah, and so with that, AJ, looks like the markets are still pulling back a little bit this week, and heading into next week, what do you think we should be keeping an eye on?
Everything that Serge talked about. I think that we should look for the underpinnings. I mean, you have to admit, despite having the credit cards, despite having all, repossessions of automobiles, despite all this stuff happening, there's just this optimism in investors that, they're almost blind by what's actually happening with the underpinnings. I mean, you and I look at that quantitative easing or the reversing of that quantitative easing. That story alone is pulling, it's slowing things down, but people don't want to believe it. So I agree with Serge that there's a strong possibility of yet another rally, and we want to position ourselves for that. But in the meantime, we are in this sideways choppy market. This is great for the type of trades that we want to do. So forward testing, trade planning, back testing, all of those things. That's the weekends are where I spend most of my time doing that, so that during the week, I just have to follow my baked in recipe of a process. So that's what I recommend you guys do, is you keep finding those candidates, planning out those trades, and then forward testing them. Trade those plans, but do it in a simulator paper account and compare and contrast.
And in addition to that, make sure to mark your calendar for our very special 100th episode next week. I know that internally we've been talking about some sort of a giveaway, some sort of surprise. So stay tuned, because we'll definitely try and make something special for somebody.
Back at the normal time, right, Sip?
Yeah, back to the normal time. We went an hour early today due to International
Sure.
yeah, international times. Um,
Yep.
but yeah, 99 episodes of how to make money trading options, premium selling. I mean, there's got to be at least 200-300 examples in all of those episodes of how to
Yeah.
apply your approaches. So thank you, AJ, for teaching the world to
And
revealing
thanks to
your secrets.
everybody, all the viewers. I can't believe that they've stuck with us this long as well.
Yeah, and
Mind blowing.
to that, if you are a new viewer, hit that like, hit that follow, hit that subscribe button. We appreciate it. We'll continue to do our best to provide you with quality content every week. Don't be shy. If you have any questions, leave them in the comments, send DM, head on over to tradingtrainer.com. There's some good freebie stuff over there as well. Everything that you need, tools to really help you succeed as an investor, as a trader. That's what AJ's mission is. That's what the mission behind Trading Trainer is. And so if there's any, if there's any concerns, comments, feel free to let us know. Otherwise, stay tuned and we'll be coming back next week for a special episode 100.
Yep. Take care, everybody.
All right, guys. See you next week.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.